Cash flow. One of the first things to note when talking about something called cash flow statements is that cash flow statements refer to the one and only thing in a company that you can actually pay bills with. Cash is an extremely important thing to measure, to track, and to forecast because it's the lifeblood of a company in terms of its ability to operate. Employees would like to be paid in cash, and there's just lots of things that you cannot do without it. So it's interesting to look at net income, particularly for a company that operates on the accrual accounting system, but you can't necessarily pay for things with net income unless you have cash. So whenever we do a financial analysis, one of the things you always want to do is look at a cash flow statement. There's a couple of different formats for cash flow statements. A very, very basic one that a lot of small companies use is they simply show you how much cash they have at the beginning of a period, how much cash went out and how much cash came in, and what was the difference, and how does that change the balance rolling over into the next time period. A lot of larger companies, particularly those that are publicly traded or those that are using certain types of accounting systems, do the same thing, but sometimes they organize the information in a different way, and that is that what they'll do is they'll show you the net income of the company and then adjust that number based on what we call operating activities, investing activities, and financing activities, and then show what the total change in the cash balance was for the period of time in question. Everyone really cares about cash. It's one of the things that really concerns investors, relates to the long-term viability of a company. Employees should care about cash, suppliers care about it, customers worry about it, managers are very concerned about it. It's one of those things that always seems to be an issue. You know, how much cash can a company come up with at any point in time? Very, very important concept. We're going to look at a sample cash flow statement from General Electric Corporation, and this is organized in the manner that was described where you have net income at the beginning. So here is $17.4 billion in net income. These numbers are in thousands for the year, for the period, for the date of December 31st, 2008. And then you'll notice that they adjust that net income number to show us how much cash really flowed in the company by accounting for something called operating activities. You know, what happened to that cash balance? Well, one of the things that happened was that they added back depreciation. This is something that was taken out of the income statement, but that you never really wrote a check for or gave cash to someone for. So that cash is still there. So we add that back. You'll notice that they make a few other changes here, some alterations to the total balance based on what's going on with inventory and liabilities and some other things. They make some adjustments based on investing activities. Here it looks like maybe they invested some money, $16 billion, which means cash goes out. So that's a negative impact on your cash balance. And you'll see some of the other impacts over the years of different things that they have done. Financing activities relates to either raising money or paying out money to people who own the company. And here you see that they paid dividends of $12 billion. Well, that means cash decreased by that amount. It looks like they sold stock, so someone gave cash to the company for that stock. And when you net all these things against each other, you started out with the net income balance of the company, and then you netted out changes to operating activities, investing activities, and financing activities. What we find at the end is that there was a net change of $32 billion plus or positive to the cash balance of the company. So basically at the end of this period, December 31st of 2008, the company had gained $32 billion in cash. That's what that's saying. You'll notice that compares to what happened the year prior, $1.7 billion, and the year prior to that, which was $2.4 billion. So you would want to go through here and look at some of the things that were different to identify some of the significant changes that occurred. And that's cash flow statements. These things are oftentimes forecast, looking on a forward-looking basis, and help. These things are a great help to managers as they try to figure out whether or not they're going to need to seek new funding for different types of things, for example, or whether or not they should pay out dividends and whether or not they should make certain types of investments. Very, very critical to look at the cash flow statement for all those types of things.